Ever wonder how the world's wealthiest individuals amassed their fortunes? Hint, it's not just about earning a high salary. It's about utilizing a powerful tool that many of us overlook: investment. Investments are like seeds, each one with the potential to grow into a mighty tree. However, not all seeds are created equal. Some may flourish into towering oaks, while others may remain small saplings. To make sense of this forest of financial opportunity, we need to explore the various types of investment vehicles. To understand the journey to wealth, one must first understand the vehicles that drive it. Imagine owning a piece of a successful company like Apple or Amazon. That's exactly what stocks offer. Now, let's dive a little deeper into this fascinating world of stocks, a type of investment vehicle that's been favored by many, including the Oracle of Omaha himself, Warren Buffett. When you buy a stock, you're essentially buying a tiny slice of that company. You're not just a customer anymore. You're an owner with a vested interest in the company's success. As the company grows and profits, so does your investment. This is the potential for high returns that attracts so many to the stock market. But as with any investment, there's no such thing as a free lunch. Stocks can fluctuate in value, sometimes dramatically. This volatility is a part of the stock market's nature. One day, your stocks might be soaring high, and the next, they might take a nosedive. So, while the potential for high returns is there, so is the risk of significant losses. That's where the wisdom of experienced investors like Warren Buffett comes into play. Buffett, one of the most successful investors of all time, is a big believer in the power of stocks as a long-term investment. He's often quoted as saying, "Our favorite holding period is forever." This underlines his belief in sticking with your investments, riding out the market's ups and downs, and reaping the rewards in the long run. Remember, investing in stocks is not about making a quick buck. It's about buying into a company and sharing in its success over time. It requires patience, research, and a stomach for risk. But the potential rewards can be well worth it. And let's not forget, stocks are just one type of investment vehicle. There are many other ways to grow your wealth, each with its own set of risks and rewards. Thus, while stocks can be a risky ride, they also hold the potential for substantial reward. This makes them an exciting and important part of any balanced investment strategy. What if you could lend money to the government or a company, and they pay you interest in return? Welcome to the world of bonds. Imagine you're in a situation where you have some money to spare. You want to invest it somewhere safe, where the risk of losing it is comparatively low. Sure, the return might not be as dazzling as it could be with riskier investments, but at least you'll sleep better at night. If that sounds like you, then bonds might just be your cup of tea. Bonds are essentially IOUs. When you buy a bond, you're lending money to the issuer of that bond, which could be a company or the government. In return, the issuer promises to pay you back the money you lent them after a certain period, known as the bond's maturity date. Plus, they'll pay you interest along the way. A little thank you for letting them borrow your cash. What makes bonds a more stable investment vehicle? Well, unless the issuer goes bankrupt or defaults on their debt, you're almost guaranteed to get your money back. And even in the rare event of a default, bondholders are usually first in line to get their money back. Now you might be thinking, that sounds great, but surely there's a catch. Well, yes and no. The downside to bonds is that the returns are typically lower than what you could potentially earn from riskier investments like stocks. But then again, lower risk, lower returns. It's all about striking a balance that works for you. Famous investors like Ray Dalio understand this balance. Dalio, the founder of Bridgewater Associates, one of the world's largest hedge funds, incorporates bonds into his portfolios. He knows that bonds can provide a steady stream of income while mitigating some of the risks associated with other types of investments. So if you're looking for a steady, reliable investment vehicle, bonds might be worth considering. They let you lend money to the government or companies, earn interest, and sleep better at night, knowing that your investment is relatively safe. Bonds, then, offer a safer but slower route on the journey to wealth. Ever wished you could own a bit of everything? Mutual funds might just be your ticket. Just like a buffet offers a medley of dishes, mutual funds offer a collection of various investment types like stocks, bonds, or other assets. This grouping of investments is what we call a portfolio. But here's the kicker. You don't have to do the heavy lifting. A professional money manager does the work, making the investment decisions for you. So why are mutual funds such a big deal? One word: diversification. By spreading your investment across a variety of different assets, you can minimize your risk. If one asset performs poorly, another might do well, balancing things out. It's like that old saying, don't put all your eggs in one basket. With mutual funds, you're spreading your eggs across many baskets, and you're not alone in this journey. Some of the most successful investors are big fans of mutual funds. Take Peter Lynch, for instance. This Wall Street legend who managed the Fidelity Magellan Fund is known for his advocacy of mutual funds. He believed in the power of diversification and the potential of mutual funds to provide it. But let's be clear, mutual funds aren't a magic bullet. Like any investment, they come with their own set of risks. But the beauty of mutual funds lies in their simplicity and accessibility. Whether you're a seasoned investor or just starting out, mutual funds can be a valuable addition to your investment toolkit. Let's circle back to our buffet analogy. You wouldn't fill your plate with just one type of food, right? Variety is the spice of life, after all. The same concept applies to your investments. By diversifying your portfolio with mutual funds, you're not just investing in a single company or industry. You're investing in a slice of the entire market. So, if you've ever dreamed of owning a bit of everything without the need to constantly monitor your investments, consider mutual funds. They offer a simple way to diversify your investment portfolio, potentially reducing risk and smoothing your investment journey. How about investing in something you can touch and feel? Real estate investments offer just that. As we journey through the world of investments, we've explored shares, bonds, and even diversified portfolios. But what if we take a step outside, literally, and look at the physical world around us? Real estate, properties, lands, buildings. These are tangible assets, investments you can see, touch, and even live in. Just like any other investment vehicle, real estate has its own unique set of advantages. It can provide a steady stream of income if you decide to rent it out. And over time, the value of the property itself can increase, leading to capital appreciation. But don't just take our word for it. Some of the wealthiest people on the planet have amassed their fortunes through real estate. Take Donald Bren, for example. This billionaire real estate investor and property developer has a portfolio that includes over 100 million square feet of prime real estate in Southern California. Bren started his journey with a small investment in a home building company and gradually built his empire, proving that real estate can indeed be a profitable investment vehicle. But is real estate investment only for the rich and famous? Absolutely not. Many ordinary people have found financial success through real estate. It's all about starting small, learning as you go, and making smart decisions. Yes, there are challenges. Property maintenance, dealing with tenants, understanding local real estate laws, and market fluctuations can all be part of the real estate investment journey. But with due diligence, patience, and a bit of savvy, these hurdles can be overcome. Remember, investing is not a one-size-fits-all approach. Different investment vehicles suit different people, and what works for one person might not work for another. Real estate is just another option in this vast investment universe, offering a tangible path to wealth, with potential for both income and appreciation. So why not consider adding some bricks and mortar to your investment portfolio? After all, as the saying goes, they aren't making any more land. Real estate offers a tangible path to wealth, with potential for both income and appreciation. So, why does all this matter? Why should you care about stocks, bonds, mutual funds, or real estate? Well, let's recap what we've discovered. Investing in a company through stocks gives you a share of its future profits. As Warren Buffett, one of the most successful investors, said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." This emphasizes the long-term potential of owning stocks. Then we have bonds, where you lend your money to the government or a company. They pay you back with interest, providing a steady income stream. As billionaire investor Howard Marks put it, the safest and most potentially profitable thing is to buy something when no one likes it. Bonds can be that something when the stock market is in turmoil. Mutual funds allow you to spread your risk across a variety of investments. As legendary investor Peter Lynch pointed out, diversification is the only free lunch. This way, you're not putting all your eggs in one basket. And lastly, tangible assets like real estate offer a physical investment that can provide both income and potential appreciation. As Andrew Carnegie, a famous industrialist, once said, 90% of all millionaires become so through owning real estate. Remember, the journey to wealth isn't about how much you earn. It's about how much you keep and grow. Choose your vehicle wisely and let the power of investment drive you to your financial goals. All right, guys, that's a crash course on some of the most common investment vehicles. But the question remains, which one is right for you? Here's where things get interesting. Let's break it down. If you have a growth seeker mindset, then stocks might be your jam. High potential returns, but also more risk. If you have a safety-first mindset, then bonds offer stability and predictable income, but growth might be slower. If you have a diversification fan mindset, then mutual funds and ETFs can be your one-stop shops for a variety of investments. So what kind of investor are you? Leave a comment below and tell us which investment vehicle piqued your interest the most. And don't forget to like this video if you learned something new. Want to dive deeper into specific investment vehicles? Hit that subscribe button for more financial education content. We also have other videos on topics like budgeting tips and building your emergency fund. Check out our playlist to keep building your financial knowledge. Investing can feel overwhelming, but with the right information, you can make informed decisions and take control of your financial future. Let's get out there and conquer those investment goals together. Until next time, keep an eye out for a brand new way to save and invest.